Earlier this week, Finance Minister Nirmala Sitharaman in the Parliament defended the fall of the Indian currency, the rupee. The value of the rupee fell to 80 rupees to a dollar before recovering from that level. Overall, the rupee has depreciated 6% to the US dollar since the beginning of 2022. If we compare with the earlier data since December 2014, the value of the currency has depreciated some 26.7%. Foreign brokerages like Nomura and Goldman Sachs are now forecasting that the rupee will fall by another 1.5 to 2% to 82 rupees to a dollar. Public discourse has now moved to how bad the situation can get if the value of rupee falls below this level. But how does one decide whether the rupee depreciation is good or bad? In this video today, we're going to throw some light on the overall macroeconomic situation in India and how that compares with the rest of the world. And then understand the position of the domestic currency vis-a-vis that of currencies to derive the current rupee depreciation is driven by market forces and it is not all that bad. So how is the value of rupee determined against the US dollar? Why are most currencies globally pegged against the US dollar in the first place? There are various factors that determine the value of a currency, including how a country's demand for its exports is faring, what are the capital flows into the country, the level of interest rates in a country, and what is the outlook on the performance of the global economy. The value of rupee is pegged to a dollar because the US dollar is a reserve currency. In this video, I will not get into why the US dollar is a reserve currency, but for a broad perspective, it's important to know that all other major economies like the European Union, the United Kingdom, China, Japan and Australia among others hold more than half of their currency reserves in the dollar. Around 85% of the global trade takes place in the US dollar. Now let us rewind a bit to the beginning of the COVID-19 pandemic in April 2020. As the lockdowns took place one after another in different regions across the globe to tackle the spread of COVID-19, most economic activities had come to a halt. Few months later, when countries started lifting these lockdowns, companies were finding it difficult to procure raw materials from other countries, and there were massive disruptions in the supply chains, which started reflecting in the prices of the commodities, fueling inflation. At the same time, to give a boost to demand, central banks across the globe had lowered interest rates to record lows. Even in India, the Reserve Bank of India had sharply cut its key policy rates, falling to the low of 4%. It is after the second wave of COVID-19 that countries learned to live with the virus and took firm steps to open up their economies. This time, demand came back strongly, leading to the rise in prices of goods and services. Beginning 2022, the world experienced another supply shock after Russia invaded Ukraine on 24th of February and the West imposed harsh sanctions limiting trade with Russia. Prices of all key commodities that Russia exported to the world, like the oil, mineral fuels, iron, steel, fertilizers, electronic equipments went up. There was a global squeeze on all these commodities, leading to increase in international prices of all these commodities, which further fueled inflation in the domestic economies. Today, inflation in most Western countries is at their historic highs. Inflation measured through CPI or Consumer Price Index touched a 40-year high of 8.8% last week in the United States. The UK has it at 9%. Similarly, in the euro area, annual inflation is expected to be 8.6% in June 2022. In India, the CPI inflation has been above 6% since the beginning of 2022 and is likely to average around 6.7% in the current financial year, according to the Reserve Bank of India. Now, to combat inflation, central banks started aggressively increasing the interest rates to suppress demand. Bank of England was the first central bank that increased its key policy rates, which currently stand at 1.25%. The Federal Reserve of the United States increased its funds rate to 1.75%. There are concerns that Fed may increase its key rates to around 3.25%, which may cause a global recession or a recession in the US economy to begin with, which will suppress the overall demand. This is a major reason why India and other emerging market economies have witnessed huge capital flowing out of their countries. When interest rates rise in the advanced economies, investors find it more beneficial to park their money in less riskier assets like the US Treasuries, gold and other securities that are denominated in dollars. Moreover, Higher interest rates are more lucrative for foreign investors. When there is more dollar outflow than inflow, the currency weakens. This is one of the reasons why the rupee has witnessed a sharp decline in its value since the beginning of the year. According to the government, foreign portfolio investors have withdrawn about $30 billion from Indian equity markets since April. Of this, $14 billion have been pulled out just in April and May. Now, the other argument is whether the rupee is the only currency whose value has declined in the last few months or the impact is broad-based. For better analysis, if one were to pick a basket of 10 major currencies globally that are widely traded, like the euro, British pound, Japanese yen, the Chinese yuan, Australian dollar, Canadian dollar, Swiss franc, and see their peg against the US dollar, one gets a clear picture on what really is happening in the global currency markets. All these major trading currencies have fallen against the US dollar in the current calendar year, with the Japanese yen falling as much as 16%. British pound has depreciated 11% against the US dollar, euro by 10%, and China and India have depreciated by 6%. Therefore, the way to look at this data is how the dollar has strengthened against all major trading currencies, and that has happened because of the aggressive interest rate regime in the US, and the fears of a global recession have pushed investors to park their money in dollar. In fact, the data shows that the rupee has strengthened against the euro, pound and yen. Now let's shift a bit and talk about India's trade balance. While international commodity prices have started rising towards the end of 2021, the world was met with another shock, as discussed earlier, when Russia invaded Ukraine. This is when the steep rise in global commodity prices started weighing on India's current account balance. Since India is a net importer of some price inelastic commodities like oil, coal and gold, it runs a high current account deficit. Usually, the current account deficit is paid through the capital inflows, but in the absence of such flows like the current year, the RBI has to dip into its foreign exchange reserves. In the last 6.5 months, the Reserve Bank of India's foreign exchange reserves have gone down by $53.36 billion, either by intervening in the spot market for currencies or paying for the imports. As of 8th of July, India had forex reserves of around $580 billion. On the export front, while it is considered good for a country's exports if the domestic currency depreciates, the value of the export goes up. But in the current scenario, since the costs of domestic goods have risen, the demand for exports may be affected. Now, what is the way forward? Should the government and the RBI prevent the fall of the rupee? It is difficult for the RBI to indefinitely defend the rupee and use its reserves for that. Experts in the market believe that as a strategy, the RBI should let the rupee depreciate and act as a normal shock absorber to the negative terms of trade. That's all from me. This is Shubham Batra for ThePrint. Do subscribe to our YouTube channel and follow us on Instagram, Twitter and Facebook.